Joining me right now, ahead of that all, is CFA Penn Mutual Asset Management Chief Investment Officer, Mark Heppenstall. Mark, great to see you. Thanks so much for being with us. What are you expecting from the inflation data this week, and has it changed the way you allocate capital?
Good morning, Maria. Great to be with you again. So we do expect the inflation data this week to moderate as it did last month. So we do think inflation has peaked. But I think the real key question for investors is whether inflation is going to gradually get back to the Fed's 2% target anytime soon. And I think that's where the inflation picture is likely to stay trickier for Fed policymakers, as we think shelter costs, a tight labor market is unlikely to help get inflation back to the target anytime soon. So again, we think that makes the outlook for equities and interest rates somewhat more problematic. We think the volatility is likely to stay elevated for the balance of the year, and even though the reaction more recently to the turn in inflation has been for a pop in equity markets, we do think volatility is likely to remain for the balance of this year.
Yeah, I mean, because when you look at inflation, when you look at how the Fed will react, that is going to dictate or at least encourage you to allocate differently. We had Kathy Wood on last week from ARK Invest. She's all in on growth. She's had a tough year after having a huge string of gains, but she thinks that the Fed will get inflation down to the targets, and that PCE index will go from 4.6%, where it is now, to a 3% handle in 6 months, Mark. I guess the question for me is, what does that mean in terms of the macro story? I mean, for example, you look at the price of oil right now. Rising to a 2-week high yesterday, this morning, fractionally moving on Brent and crude oil, but below $100 a barrel. Why? Because of demand, because of a weakening macro story. So as we watch inflation come down, do we also worry about recession going up?
Well, I do think that fears among investors have gradually shifted this year. We started off the year worried about high inflation, and clearly those concerns came to fruition with, the CPI registering above 8%. And now those fears are transitioning more towards an economic slowdown. And so we do think that the Fed is likely to hike interest rates by 75 basis points. And, they've been really focused on inflation, I would say since the financial crisis until this year. Their maximum focus was on full employment as opposed to price stability, and that dynamic has shifted. So the scales are now tipping much towards inflation, controlling inflation. So we think 75 basis points is in store. And unfortunately, the economy is showing signs of slowing. If you look at the Atlanta Fed GDP now for the third quarter estimates, it's just barely above 1%. So unfortunately, the Fed is going to be tightening aggressively into what looks to be a slowing economy. And that's, again, where we think the outlook becomes trickier for financial assets in light of Fed tightening, higher interest rates. We just think that spells more volatility for markets.
Yeah, I mean, it's hard to understand how recessionary times could be happening when we're still generating 300,000 jobs every month. People are expecting job cuts to start spiking. And this morning, we've got news from Goldman Sachs leading the way for layoffs on Wall Street. Goldman announcing it will lay off hundreds of workers beginning as soon as next week. Mark, what does that mean in your view for Goldman's earnings? Do you see this as sort of a predictor of what's to come for Wall Street? Are you expecting layoffs?
Well, we do think there will be more layoffs as the economy begins to slow. And we do think that generally, banks and financials have benefited from the rise in interest rates, where the bond market is making the outlook more complicated for financials with the slope of the yield curve. And clearly the yield curve inversion is a predictor of a slowdown in economic growth, and that tends to be a negative for bank and finance earnings. So, we do think that the economy is going to slow, and we are going to see a weakening outlook for the labor market as the year progresses.
All right, so you've said a few times volatile markets for the rest of the year, Mark. Are you selling into today's rally? What does that mean?
Well, we do think that the economic fundamentals, the weakening outlook for earnings, rising interest rates are not a great recipe for sustained equity market rally. So we think it eventually comes back to economic fundamentals, to the earnings outlook. And we think that's where we are likely to see more weakness across the equity markets for the balance of the year. So again, my year-end target is just about where we sit today, but I do think that there's going to be a lot of volatility to end up there at the end of the year.
All right, we will leave it there. Mark, great to catch up with you. Thanks very much. Mark Heppenstall joining us this morning
Thanks,
from
Maria.
Penn Mutual Asset. Thank you so much.